Welcome to the Deep Dive, where we cut through the noise to get you well-informed, fast. Today we're diving into a pretty provocative idea from our sources. If you want to succeed in the high-stakes world of investing, maybe you should do the exact opposite of what Wall Street often preaches. Instead, our research suggests you might want to invest like a girl.
Now, that's definitely a phrase designed to grab your attention, isn't it? But it's more than just a catchphrase. We're looking at the surprising research-backed link between temperament, gender, and, well, long-term investing success.
Exactly, and we're drawing lessons from the pretty dramatic backdrop of the 2008 financial crisis. We're using insights from the fascinating book Warren Buffett Invests Like a Girl, and also some candid interviews with seasoned value investors.
Yeah, some really good sources for this one.
Our mission today is pretty clear. First, unpack why temperament is, maybe now more than ever, so crucial. Second, distill these feminine investment traits that research shows lead to consistent results. And third, discover how arguably the greatest investor of all time, Warren Buffett, actually embodies these qualities.
So the idea is you'll walk away with some really actionable insights, things you can use to cultivate your own, rock-solid investing mindset.
Right. Let's get into it. Okay, let's cast our minds back. September 2008. You had Britney Spears making a VMA comeback, Lance Armstrong returning to cycling, Hurricane Ike. A busy month. Felt almost normal on the surface.
Yeah, the U.S. presidential election was in full swing, too. It felt like just another month in many ways. But underneath all that, something else was brewing. A financial storm.
And then, boom, suddenly everything changed. Like less than 2 weeks into September, this wave of financial panic just seemed to engulf everything.
It really did. There's this 19th century Yale professor, William Graham Sumner, who defined panic perfectly. He said it's a wave of emotion, apprehension, alarm. More or less irrational. It exaggerates, takes away courage and energy. And honestly, that was exactly what happened in 2008. A terrifyingly accurate description.
And we'd already had a warning shot, hadn't we, back in March?
We had. Bear Stearns.
Yeah.
Forced into a fire sale. They were just crippled by too much leverage, and the housing market was clearly starting to wobble. That whole subprime lending boom, well, it was starting to unravel spectacularly.
So the signs were there, but September was the real cliff dives.
Absolutely. Financial firms everywhere, their balance sheets were choked with toxic debt. But the trigger, the thing that really tipped it over the edge, was the Lehman Brothers bankruptcy. The government decided not to step in this time, and that decision just sent markets into absolute freefall.
Trust just evaporated, didn't it?
Overnight, credit markets froze solid. Panic was the only game in town.
It reminds me of that Buffett quote, "You only learn who has been swimming naked when the tide goes out."
Ah, yes. And according to our sources, Wall Street in the fall of 2008 became, well, a virtual nudist colony. And it was not a pretty sight.
I can imagine. The numbers were just staggering.
Weren't they? The Dow Jones dropped below 10,000, then 8,600 just days later. The S&P 500 down 42% in a single year. Wiped out years of gains.
Imagine watching your retirement savings just evaporate. Our sources describe it as portfolios shrinking to just a wisp.
Yeah, feeling compelled to watch the news like a car wreck, knowing we were all in this car together as it crashed. It was incredibly demoralizing. That feeling of your 401k, your nest egg, just vanishing, it was palpable.
So what do our sources point to as the root causes? What were the fundamental flaws?
Well, they really zero in on some critical temperamental flaws, things like rampant short-term thinking, ridiculous levels of risk-taking, completely unreasonable debt.
And this almost irrational belief that the party would just never stop.
Exactly. An irrational belief that greed-driven profits could go on forever. Plus, cynical profiteering, a real disregard for the long-term consequences. Wall Street, particularly, our sources say, got dirtied with even more temperamental filth.
How so?
They were fueling this irrational behavior using excessive leverage and operating with this macho, me first, make money no matter what cutthroat culture. It spread the housing collapse far and wide.
But it wasn't just Wall Street, was it?
No, definitely not. Homebuyers played a part, too. Many took on those extreme interest-only or adjustable rate mortgages. They were kind of hoping the bubble would keep inflating, that they could sell before the payments jumped up. It was a collective lapse in judgment, really.
Which brings us back to the core question. What if there was a different way? What if a calmer, maybe more thoughtful temperament had been more common?
And that's exactly where this idea of investing like a girl comes in. It's fascinating because behavioral economics research does consistently show differences. Women often approach investing with a distinctly different, and often more successful temperament than men. And this isn't just, stereotypes, it's backed by data.
Okay, let's break down these key traits our sources identify.
Yeah.
First up, they trade less. Tell us about that.
Right. So studies by Barber and Odine, for instance, found women's trading actually hurt their performance less than men's. It wasn't necessarily superior stock picking, but rather less overconfidence driving them to trade constantly.
So men trade more because they think they can beat the market.
Often, yes. They tend to trade away their potential profits. Vanguard even looked at data during the 08-09 panic. They found women were more likely to just stay put, ride it out, whereas men more frequently freaked out and sold right at the bottom.
Wow, that calm is a huge advantage. Which leads to the next trait. They exhibit less overconfidence.
Exactly. On average, men tend to overestimate their knowledge, their abilities. Women are often more likely to say, I don't know, or acknowledge the limits of their knowledge. That self-awareness is incredibly valuable in investing. Overconfidence drives so many mistakes.
Like taking on too much risk. So how does that play out? Do women really shun risk more?
Well, the data suggests they do. Studies show women generally hold less risky positions. One of the value investors interviewed, Lisa Rapuano, she mentioned that while she probably takes more risk than most women, her decisions are always very calculated, deliberate.
It's about managing the downside, not just chasing the highest possible return.
Precisely. It's a different focus.
And what about their overall outlook? Less optimistic, more realistic. How does that help?
Optimism is great in life, but in investing, it can poison your judgment, as one source put it. It can make you overestimate your skills, take on too much risk, and fall for confirmation bias, only seeing what confirms your rosy view. A more realistic, grounded perspective helps you spot potential problems before they happen.
That realism probably encourages more digging, right?
Is it true they put in more effort researching?
Absolutely. The tendency is towards more thorough research, really considering different angles, asking, what am I missing here? Lisa Rapuano talked about how a thriving curiosity in reading broadly history, science, even novels, builds more connections in your brain. It enhances pattern recognition.
Interesting. And what about resisting the crowd? More immune to peer pressure?
Yes, the sources suggest women are often better at sticking to their strategy, regardless of what the herd is doing or what the latest hot trend is. That independence is crucial for long-term success. You can't just follow fads.
And when things inevitably go wrong, do they learn from their mistakes more effectively?
There was a Merrill Lynch poll that found women are better at this. It sounds simple, but it's huge. It means setting ego aside, analyzing what actually went wrong, and adjusting, not making the same mistake twice.
Okay, and the last one is really fascinating, the biological angle. Less testosterone. How does that connect? Yeah, neuroeconomics research looks at this. Higher testosterone can sometimes link to increased risk-taking and maybe faster decisions. That might be useful in, say, high-frequency trading, but for long-term investing. Too much can fuel excessive risk and kind of exaggerate market bubbles.
So hormones can amplify market swings.
Potentially, yes. And conversely, high levels of cortisol, the stress hormone, can lead to irrational risk aversion, maybe making downturns last longer. The takeaway is that hormones might exaggerate market moves, which really highlights why emotional regulation is so important for investors.
These traits together paint a really compelling picture of a steady, successful investor. But you could argue maybe too much caution misses big growth opportunities. Do we have examples where this approach clearly won?
We do. A really stark one is the case of Iceland. Remember them? Tiny fishing nation turned international finance hub.
Oh yeah, driven by those aggressive male bankers, as our sources put it.
Exactly. Their national debt exploded 850% of GDP. They were right on the brink of total bankruptcy in 2008.
An incredible boom and bust.
Right.
But the turnaround,
yeah,
that's a key part, right?
That's where it gets really interesting. When the whole system imploded, it was largely female Icelandic politicians, bankers, business leaders who stepped in to clean up the mess. There was this firm, Oddur Capital, founded by Halla Tómasdóttir and Kristen Pettersdóttir. They explicitly built it on feminine values, caution, ethics, long-term thinking.
And how did they fare during the crisis?
Remarkably well. They survived intact, even thrived, while everything else around them was collapsing. It's a powerful illustration of how a different temperament can produce vastly different results.
So these traits, patience, realism, research, risk management, independence, they form an ideal investing mindset. But who really embodies these traits best? Who is the ultimate feminine investor, even though he's, well, not a woman?
Yeah, if you look at all these traits, they point squarely at one person. Warren Buffett. Born in Omaha, 1930. showed a knack for business early on, but it was studying under Benjamin Graham at Columbia that really set his path as a value guy. And what's incredible is how his core investment principles just perfectly mirror these feminine traits we've been discussing.
It really is uncanny. Let's connect the dots. First, trade less, take the long view, be patient. How does Buffett nail this?
Well, fundamentally, Buffett sees buying stock as buying a piece of a real, living, breathing company. It's not just blips on a screen. He and Munger even wrote an owner's manual for Berkshire shareholders, basically saying they hope people don't trade the stock frequently. He has that famous line, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
And the 20 punch card idea, too. Only make 20 investments in your life.
Right. It forces you to be incredibly selective and patient. High conviction, infrequent decisions. That's his model.
Like his Washington Post investment back in '73. It dropped 20% almost immediately, stayed down for years, but he held on. Patience.
Incredible patience. As Lisa Rapuano said, it's low activity, it's thoughtful, it's moving more deliberately, letting businesses compound value over time.
Okay, next trait. Reining in overconfidence, staying within your circle of competence. How's Buffett on this?
Oh, this is absolutely core to Buffett. Knowing what he knows, and maybe more importantly, knowing what he doesn't know. He famously avoids most tech companies, saying they're outside his sphere of understanding, even though he's friends with Bill Gates.
He passed on Intel way back when.
He did. And value investor Lauren Templeton echoed this. If I can't value it, I can't invest in it. That discipline keeps you out of trouble, especially in complex or frothy sectors.
So he sticks to businesses he can genuinely understand.
Exactly. Things like newspapers, railroads, strong consumer brands like Coke or See's Candies, insurance like Geico, businesses with durable advantages, wide moats that he can analyze. Your circle might be different, of course, but the principle holds. Stay where you have an edge.
And risk.
Ah.
How does he shun excessive risk, use a margin of safety, and avoid debt?
He fundamentally tilts towards owning businesses, not speculating on prices. That limits risk right there. And the margin of safety is key, buying something for significantly less than you think it's truly worth.
Like the Washington Post example thought it was worth $400, bought when the market said less than $100.
That's a massive cushion. Plus, he's deeply averse to excessive debt, both for companies and individuals. He compares credit card debt to corporate over-leveraging. Both are dangerous. And sticking to a circle of competence naturally reduces the risk of making bad calls.
Makes sense. What about outlook? Is he just an optimist, or does he embrace the positives of pessimism, staying realistic?
Well, he's definitely optimistic about America long-term. Remember his Buy American IM op-ed in 2008. But as an investor, he's careful not to let that optimism cloud his judgment. He often says, pessimism is your friend, euphoria the enemy.
And the Mr. Market idea.
Yeah, Ben Graham's analogy. Mr. Market is this manic-depressive partner offering crazy prices daily. The point is, you're in charge of your emotions, not him. You don't have to act on his whims. Be realistic. Be level-headed.
It sounds like he prioritizes facts over feelings, which connects to researching extensively, craving knowledge, and avoiding confirmation bias.
Absolutely. His reading habits are legendary. Newspapers, reports, filings. He has this incredible, thriving curiosity. Like Lisa Rapuano said, reading widely builds mental connections, helps you spot patterns others miss. That deep knowledge is his shield against confirmation bias.
He seems unusually good at admitting when he's wrong, which helps fight that bias too.
It's rare, isn't it? He openly discussed being dead wrong on ConocoPhillips. He seems to actively look for information that challenges his thesis, not just confirms it. A powerful habit.
Then there's his independence, ignoring peer pressure, being contrarian, sticking to convictions.
He's unwavering. Even back in the 60s tech bubble, the go-go years, when everyone else was making easy money, he stuck to his value principles because he understood the logic. He didn't chase the fad. That's when he developed his famous be fearful when others are greedy and greedy when others are fearful mantra. He bought heavily when markets crashed in the 70s.
He trusts his own reasoning.
Completely. Roger Lowenstein wrote that Buffett is comfortable following his own instincts and ignoring the consensus. He avoids fads. He lives by his inner scorecard. His own judgment matters more than public applause.
And mistakes. We touched on admitting them, but does he truly learn from them?
Oh, absolutely. He dissects them in his shareholder letters, focusing on the decision process, not just the outcome. He talks about mistakes of omission, like missing Walmart, costing billions in opportunity, but also mistakes of commission, like buying Berkshire Hathaway as a textile mill initially. The dumbest stock I ever bought, he called it.
Or U.S. Airways, which he bought out of impatience.
Right. He admitted the analysis was superficial and wrong because he was impatiently looking for stocks. Even though he eventually made money on it, he knew the decision was flawed. And the Irish banks and ConocoPhillips in 2008, the world changed fast, and his analysis got turned on its head. It shows even the best make mistakes, but learning is key.
Moving beyond just the numbers, he also seems to really value people and relationships. How does that fit in?
He strongly believes a business is only as strong as the people running it. He's known for being an excellent judge of character. He admires managers like Rose Blumkin at Nebraska Furniture Mart or Jim Sinegal at Costco. Other investors we looked at, like Lisa Rapuano and Amelia Weir, emphasize judging management by their track record of capital allocation, but also listening to their tone on calls. Are they straightforward? Do they get it?
So assessing the people is crucial.
Definitely. And Buffett's own key relationships, Charlie Munger, Bill Gates, his late wife Susie, show how much he values connection and collaboration.
And despite learning from giants like Ben Graham, he never stopped evolving. He was willing to question the masters.
That's right, the learning never stops. Charlie Munger significantly influenced him, moving him beyond just buying cheap cigar butts towards valuing truly quality businesses, even if they weren't dirt cheap. He realized sometimes cheap is cheap for a reason, like that Baltimore department store with plain old bad economics. It's about continuous refinement.
And finally, his commitment to acting fairly and ethically.
It's fundamental to his reputation. He insists on equal information for all shareholders, no selective disclosure. He aims for complete candor in reporting, telling shareholders what he would want to know if positions were reversed. He even got investigated for potentially overpaying for Wesco, just to be fair to existing shareholders.
And the Salomon Brothers scandal quote is legendary.
Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless. Integrity is paramount. It builds trust, which is invaluable.
Okay, so we've really unpacked this feminine investment temperament, patience, realism, research, managing risk, independent thought. It's backed by behavioral economics, and it seems to be the exact blueprint for Warren Buffett's success. So what's the big takeaway for you, the listener, on your investing journey?
Well, the key thing is that these traits, this temperament, it's a powerful template for all investors. It doesn't matter if you're male or female. It's about adopting a specific mindset, viewing stocks as ownership in real businesses, having the patience for long-term compounding, saving diligently.
And staying humble, right, sticking to what you actually understand.
Exactly. Having the humility to know your limits, your circle of competence, and the courage to ignore the market noise, learn from your inevitably mistakes, and just stick to your plan.
This deep dive really makes it clear. Both men and women can absolutely cultivate these powerful traits. It definitely takes practice and hard work and self-awareness, no doubt about it. But the path to consistent, persistent investment results seems clearer. Don't just sit on the sidelines. Put that excellent temperament to work.
Yeah, the potential rewards are significant.
So as you reflect on everything we've discussed today, here's a final thought. What one feminine investment trait will you consciously decide to cultivate starting today to help build your own remarkable